When it comes to investing, more risk does not necessarily equate to higher long-term potential gains. I'll give you an example. Let's say you take investor A, who's 100% stocks, and investor B, who is 70% stocks and 30% bonds. So if you take a look, investor A, you would expect would have higher potential long-term returns because more risk equals more return. We're humans. We have emotions. We make mistakes. Now, let's say 3 examples. The stock market tanks. Investor A overestimated his or her risk tolerance. So investor A panics, sells into a down market, doesn't get back into the market, misses the recovery. How did investor A do compared to investor B, who's taking less risk? I would say investor A just suffered a major setback to his or her long-term upside potential. Let's say investor A doesn't have an emergency fund, and now investor A needs to sell their stocks potentially into a down market. That could hurt investor A's long-term upside potential severely. In that example, let's say investor B has an adequate emergency fund and doesn't have to sell any investments when they have an emergency need. So let's say investor A and investor B are both investing monthly into their 401k plan, dollar cost averaging, reinvesting, compounding over the long term. And let's say investor A decides, I'm not making enough money now, I can't pay my bills, so I'm going to stop investing in my 401k for a little while so I can have the extra cash in my bank account. But a lot of people who do that, they don't get back into investing in their 401k plan because their expenses grow into that extra money that was going into the 401k plan. So how does that affect investor A's upside growth potential over the long term? Could impact them a lot. Investor B, though, who has an emergency fund, who has adequate earnings to pay their bills, and who has a portfolio that he or she could stick with in both up markets as well as down markets, I would say in all 3 examples, investor B, even though he or she is taking less risk, has the upper hand in upside returns potential because of his or her personal finance habits, which to me is more important than just having an investment portfolio that is more risky in order to earn a higher return over the long term. That's why I always emphasize it's a matter of time in the market, not timing the market, because as humans, we are notoriously bad at timing the market.